Welcome to week 3, and I'm going to include week 4 in this video. And we're going to cover the 2 more chapters in your MBA book, as well as the waste management expense recognition case. You know, we looked at the revenue recognition principle last week that you're working on your case and your paper there to show your learning and your understanding of the revenue recognition as a business leader in your company. A lot of fraud is involved with revenue recognition. And then we're also going to look here today, this week, the expense recognition. Because you remember me making that comment last week that you recognize revenue in the period in which it is earned. That's the accrual basis of accounting, not cash basis. When it's earned, regardless of when you receive payment, and then you want to match your expenses with that revenue that's associated with that revenue, whether it's depreciation expense or any expense that's been incurred, whether it's been paid or not. That's the accrual basis. So when you take these 2 case studies we're looking at, revenue recognition and expense recognition, or really a better term would be expense matching, that's 95% of what goes on in your accounting department, your financials. So it's very important to understand these 2 concepts from a high level. Let me go ahead and share that case with you that's out there in your D2L content. And again, this is about waste management. And they've got this as case 1.1. And like I said, 1.2 was last week's case on revenue recognition with WorldCom. I think they've got it backwards. If I put this textbook together, I would have actually put this as 1.2. You recognize revenue, then you match your expenses. But what's going on here, this synopsis of waste management. Oh, it's got the dumpster company, right? It had materially overstated its reported pre-tax earnings. And there's another key term. Remember those 5 guidelines for GAAP? Revenue recognition, matching, which is expense. That's what we're talking about here. Expense recognition is matching. You got materiality here. And then what's the other 2? Conservatism. Be conservative in your estimates of revenue. And make sure you've got all your expenses accrued fully. And then the 5th one is consistency. So those are the big 5. Not that the others aren't important, but those are the big 5 that really go through your mind as a business leader, especially in the financial function, and making journal entries, recording entries that go against your income statement and your balance sheet. So what we see here, they had materially overstated. Well, if you overstate and it's not material, meaning it's insignificant, it's no big deal. But here they materially overstated. It's reported pre-tax earnings by 1.43 billion, which you would say that's pretty material, right? If it only been $1 million, I mean, that's a lot of money to us, but $1 million would be immaterial. But it says that the stock dropped more than 33% and shareholders lost $6 billion. And that's because the stock market, stock prices are driven based on earnings per share. It's that simple. Long-term earnings per share drives the stock market. It drives your PE ratio, and the lower the PE ratio, the more likely the stock's going to increase that multiple. And because they willfully, materially overstated this, the SEC, Securities Exchange Commission, because they're publicly traded, brought charges against the company's founder here, Dean Buntrock. I had to look close to see what that is, and 5 other top officers. So this isn't just about accounting people being indicted or going to jail. When you're moving up through an organization, you become accountable for things that you say, well, I really didn't know what was going on. Well, you better know what's going on, and you better know what the details are. And when you hear of something, that's when you need to raise a red flag and be a whistleblower if you have to. Like Sharon Watson at Enron. All right, so here it says that they made changes to depreciation-related estimates to reduce expenses. Depreciation-related estimates. and employs several improper accounting practices related to capitalization policies. What's capital versus what's expense? I talked about that last time about with materiality of having a threshold of what's capital and what's expensed, regardless of what the useful life is. So let's read on through here and see what it has to say about this. But it says the final judgment, SEC permanently barred Ben Truck and 3 other executives from acting as officers or directors and required payment from them of $30.8 million in penalties. So I don't know, it must not have went to jail for this, but and like what went on with the revenue recognition with Bernie Edwards and WorldCom. But let's go ahead and look at this short case and see what it says. Here we got Waste Management's major fixed assets. Fixed assets is another term for long-term assets or property, plant, and equipment, PPE. It's not personal protective equipment, it's property, plant, and equipment. And fixed assets is just another term for that. So they got $6 billion in assets. You remember those assets you possess, you either owe on them or you own those. That's what liabilities and equities are. Assets equals liabilities plus equity. And it says that they had 100 fully operational landfills. The company both owned and operated, because that's where they take all those dumpsters. And under GAAP, right, depreciation expense determined by allocating the historical cost of tangible capital assets over the useful life of the asset. That's what that is. A cost, an asset is an unexpired cost. And it sits on your books until it's allocated out rationally against what? Against revenue that you've recognized. All right. So what's going on here? It says from 1988 through 96, 8 years, made changes in estimated useful life and or salvage values of one or more categories of vehicles, containers, and equipment. It reduced the depreciation. That's what they're trying to do. Reduce depreciation expense. What are you doing? You're increasing your net income. These were top side adjustments at the corporate level. That's what you saw there in that revenue recognition case with WorldCom. Top side, meaning somebody at the corporate level is making these entries. I worked in plants for years and had the primary fiduciary responsibility for some large plants. But there was things going on outside of my 4 walls at the corporate level that I didn't know about. And of course, I wasn't accountable for that. I'm only accountable for my level and down. And you as well, as you move up through the organization, at each of those levels, you're accountable for that segment or that area down. But when you start getting at the corporate level, these things that are being done, that's where huge impact on what can happen to you specifically in your career and also what you're doing that's impacting the company. And so here, these top side adjustments at the corporate level, again, detached from the operating unit level, which would be like a manufacturing facility, made during the 4th quarter and improperly applied cumulative from the beginning of the year. Didn't disclose these changes or their impact on profitability to investors. So in a letter to the management team, Arthur Anderson, it's interesting, Arthur Anderson's gone. That was one of the big 5 accounting firms that audit these companies' books. Today you've only got 4, and that's because Arthur Anderson is gone. They went down the tubes with Enron because they went along with a lot of the stuff that went on at Enron, which was unethical and illegal. But Arthur Anderson, and it used to be our auditor at Exide back in the 90s until they went away less than 10 years later. But Arthur Anderson there, in each of the past 5 years, had a new consolidated entry in the 4th quarter to increase salvage value. So you increase salvage value, what is that? Well, if I buy an asset for $1 million and I have a salvage value of 0, which most companies do, have 0 salvage value, you start depreciating that, well, your depreciation will be $1 million. Well, what if you decide, well, we think it's going to have a $100,000 salvage value. When it's fully depreciated, it's going to have some value that we can sell it for. And so if they decide they're going to make that 100,000, then now you reduced your overall depreciation expense over the life of the asset from 1 million down to 900,000 by increasing the salvage value. And maybe they had a salvage value of 50,000, they raised it to 60,000. or 50 to 75,000, whatever that is, that's going to impact the overall expense, and that's how you boost income. It's very simple. Some of these things that these large companies do. And the useful life. What if you say, well, we've been depreciating this $1 million asset with 0 salvage value for 10 years. We think that thing's probably going to last 15 years, that truck or that, I don't know, Gaylord or whatever it might be. And so they're just going to take that $1 million depreciation, spread out over more years, meaning less expense each year. So those are red flags, and that's what they chose to do here, to increase their net income. Second thing they did here is carrying impaired land at cost. Well, what is impairment? Impairment is something accountants have to do on a regular basis. And it can get complicated, the process here on impairment of whether it's intangibles, and it's different for, depending on if it's a finite or infinite life intangible, like goodwill versus something that's got an indefinite life versus something that's got a finite life, like a copyright, versus impairment that you look at for fixed assets. But impairment for fixed assets, which is what land is, and land is not depreciable, right? Land just sits there on your books and at historical cost, and it may rise in value. Well, you don't book an increase in the fair value of land. It just sits there at whatever you paid for it. Now, if the land is impaired, meaning it's worth less than the historical cost, and that's one of the thresholds, there are several rules that you look at there. But if you think the land has been impaired, then you would write the land down from fair value, or excuse me, from the actual cost that you paid for it down to whatever the fair market value is. So what do they say here? It says that requires the company to compare a landfill's cost to its anticipated salvage value, with the difference depreciated over the estimated useful life of the landfill. All right, so of course this is a landfill. I don't know why they're saying land, but landfill itself. Waste Management is disclosing the footnotes of the statements that the disposal sites are carried at cost and to the extent this exceeds in-use realizable value. Such excess is amortized over the estimated life of the disposal site. But it says in reality that Waste Management did not depreciate the assets and carry almost all of its landfills on the balance sheet at its full historical cost, meaning it was overvalued. That land is not worth what it was with what they paid for it. Now, most companies it is, but since it's been through all this toxic material that's there, the value of that land has gone down. In that case, you do lower the value of the land. Well, how do you do that? You have to expense it through impairment, lower that. They weren't doing that, even though they said they were. They weren't doing that. And again, that's a way that you can have assets on your books that are overvalued. Assets are overvalued in this case. All right, so you can see two things that they've done there with expense recognition that had a big impact on their financials, right? What do we see up there at the top? This amounted to $1.43 billion pre-tax, making their earnings per share much higher than it should be. Okay, the two questions I have for you here is consider the principles, assumptions, and constraints of GAAP. Define expense recognition principle. Matching, that's what I referred to it as in that PDF that we looked at last week. Why is it important to users' financial statement? So you got a lot of stuff going on here. You got expense recognition, you got materiality, consistency, right? Being conservative. Being conservative is writing those assets down to net realizable value. Meaning, if you sold that land, are you going to sell it at what it's on your books as, or are you going to sell it for an amount less? Well, if you know it's going to be an amount less, net realizable value, you should write that down. So when you, I guess, pull your thoughts together in answering these case questions in these 5-page papers for each of these cases, you need to talk about the issues, understand what's being taught in these, whether it's the MBA book or maybe not to a degree as much as this, but this text, which this text should help you understand what's in here. And even go further than that, if you want to Google some of these various topics like revenue recognition or matching to get a better understanding. That's what I want you to do in this class, because there aren't any exams, and you need to formulate in your mind as a business leader, what are these things that should be going through your mind as a Bernie Ebbers should, or this, whatever his name was, forgot his name, Dean Buntrock, what names? They need to have a working knowledge of what gap is and why you can't do what they just did here. You need to understand that. All right, and so the second part says, describe specifically how waste management violated the expense recognition principle. And I've talked a lot of that to that in what I'm saying in this video. But reread the case and formulate in your mind, what are they doing that's just not right? And do more research waste management and what went on back in this particular time frame, mid-90s. Also, like the expense, or excuse me, the revenue recognition, what went on with WorldCom. Find out what's going on there, and you need to formulate your paper to address that. And feel free to cite and use APA 6th edition to put references in and cite things. Because when you cite something like that, that cuts down a lot of what you have to write in your own words. I don't have a paper that's essentially tying a lot of different quotes together, but paraphrase what's written and cite it, but also put in your own synthesis of what's going on here, because that's the whole point of this class. It's a case-based class. You're beyond undergrad where you're giving an exam. What I went over in these two books here, that's for your own edification. It should help you get my hands right. It should help you to understand what's going on in accounting. Is what those last 2 weeks were about. And of course, we're going to continue on and talking about chapter 3 and chapter 4 in this text here in just a few minutes. It says here in your description, identify journal entry that may have been used by waste management to commit the fraud. You can do that if you want. That's not as important as you telling me the rest of what's being asked here in these first 2 questions. All right. So that gives you sort of a working knowledge, and you can replay that, and if you get it taken shorthand, make notes of it and use that in formulating your answers. All right, that's the advantage of having an online course, is you don't have to pay close attention and maybe miss something of me standing up in front of the class and talking. So you can replay it and watch, and it's not very long anyway to review this. All right, let me go ahead and let's look at, since I'm putting this 3rd and 4th week together here, we looked at chapters 1 and 2 last week, along with the revenue recognition case. We just looked at the expense recognition case, matching. So now let's look at chapter 3 and 4. And it's very brief. This is a great book. Again, it's written by Michael Griffin, MBA, CMA. That's what I am. Of course, I've got a doctorate degree as well. But it's an excellent book. I mean, when I started teaching this, I only taught it once before in the AMBA, Accelerated MBA. I went looking for something other than an accounting textbook, because the accounting textbook was like an encyclopedia of stuff that you just lose track of where you are and what's important and what's not. This gentleman is giving a real world view of what's important. What are the MBA fundamentals for accounting and finance, which is what you need to do your job, to understand what everyone else is doing in your organization relative to finance and accounting. So this is a great class we're going to get your arms around. If you feared accounting before, you shouldn't fear accounting anymore. I'm trying to make this real for you and what you need to understand and be successful. So let's go ahead and look at chapter 3 and chapter 4. And chapter 3 starts on page 37 with the balance sheet. So the balance sheet, I talked about the balance sheet. The balance sheet is a point in time. It's a snapshot. If you ever go out and get a car loan or a home loan or whatever, you may not have a balance sheet, but whoever you're getting the loan from is going to do a balance sheet for you. They want to know, what are your assets, right? What do you possess? Then they also want to know how much do you owe on that? That's your liabilities. And then the third part is the difference. What's your equity, right? Your shareholders' equity or stockholders' equity from the standpoint of a major corporation. It's the same principle. Assets equals liabilities plus equity. So this is what you do in your personal life with a balance sheet is the same as what a business does. It's just billions instead of thousands. And an income statement, again, they want an income statement. Well, their income statement is going to be, you're going to verify that you got a job, that you're employed, what your pay is. Probably want to see your check stub, right? And see that you're still employed. I can't tell you how many times I've been called and asked if so-and-so works for your company. If it's a company small enough, it's a large company, they usually don't bother for verification of employment, but sometimes they do. But that's what your income statement is your check stub. They want to see what your income is and what your balance sheet is. All right, so this chapter 3 is about the balance sheet. The elements of the balance sheet, assets, liabilities, equity. What are your assets? Current assets, we've already talked about. Current or short-term or operating assets is anything that can be turned to cash in 1 year or less. It's a measure of solvency and liquidity. So that's why under assets, you're going to see current assets, and then you're going to see what? Your long-term assets, property, plant, and equipment, or fixed assets, what we just looked at with waste management. You got your intangibles, things like patents, copyrights, trademarks, all those things. Some are amortized, some are not. Goodwill. You know what goodwill is? Goodwill is when a company buys another company and they pay more than fair market value. And when you pay more than fair market value, you've got to put that on your books as goodwill. And then it's tested for what's called impairment once a year. Usually, most companies do that once a year to make sure you don't have goodwill overstated. Very important. Just like the land was overstated, or that landfill was overstated on waste management's books. And so that's the essence of what your assets are. They're on page 40. You can read the rest of that on there. Very short chapters, all of these. But it gives you what you need to know as a non-financial business leader. And on page 42, up there at the top, it talks about your liabilities. Again, you're breaking that out into current and non-current. Your current liabilities is anything that requires cash to be paid over the next 12 months, right? The next 12, what do you have to pay cash on? Accounts payable, salaries payable, income tax payable. You might have some contingent liability like warranties that are out there that's going to have to be paid based on past estimates. Again, those liabilities were set up under the accrual basis based on when the sales were made, right? Like warranty expense, debit, warranty liability credit for the potential payout. It's based on past practice. But again, accrual basis of accounting, expense recognition, you've got to make that payable for warranty in the year or even in the month in which the sales were made, all right? And then you reduce that liability with a debit to the liability for warranties payable and a credit to cash or inventory if they want a replacement. But that can be a current or a long-term. I was in battery manufacturing for 19 years, and we had batteries. If you ever bought a battery, like at Walmart, you buy 2-year warranty, 3-year warranty, 5-year warranty, and so forth. And so that can get very complicated in keeping up with your warranty accruals and warranty liability. So you typically have both a current portion, like a warranty liability, and a long-term portion. Bonds payable, one of the ways you finance your corporation. Notes payable, those are long-term, but you do have potentially a current portion of that long-term note that's going to be in your operating or your current liabilities, if you're going to have to pay that off over the next 12 months. So you need to keep in mind that as well. Mortgage payable as well. Whatever you're going to be paying over the next 12 months needs to be in your current liabilities, and the remainder is in your long-term liabilities. If you get a mortgage on a building that you just purchased, let's say a $600,000 building, and over the next 12 months, maybe your principal payment is going to be $50,000. Well, $550,000 is going to be long-term mortgage payable, and $50,000 is going to be in your current liabilities because it's got to be converted to cash in the next 12 months. And so then those current liabilities will be compared against your current assets to see if you're solvent. And so current assets divided by current liability should be at least a 1, or else you got some cash flow issues. And then lastly, down at the bottom of the page there, you can see you got equity, and they've talked about contributed capital. Well, that's your preferred stock and your common stock. Common stock is your ownership in the company. They're the ones that vote and control who's your board of directors and so forth. And then retained earnings. The retained earnings is, again, that's the tie-in between the income statement and the balance sheet. Revenues and expenses are zeroed out to retained earnings on your balance sheet. Permanent accounts in your balance sheet. Income statement are temporary accounts. Revenues, expenses will be zeroed out to your balance sheet. That's the tie-in. That's how these things fit together. And then both your income statement and 2 balance sheets are used to prepare your statement of cash flows. But we'll get to that later on in a future chapter. Page 43 talked about the balance sheet element and the measurement criteria. Current assets net realizable value, lower historical cost or market. Again, that net realizable value, like with waste management, those landfills were worth less than what they paid for them, which kind of makes sense. So that should be on their books. That needs to be written down. When you write something down, that's an expense. It goes to your income statement. The only way to get an asset off your books is to put it to your income statement, right? Normal debit balance for an asset, normal debit balance for an expense. So if it's not on your books as an asset, right, on your balance sheet as an asset, it's got to be over here on your income statement. It's been written off. That's why they both have a debit balance. So you credit the asset and you debit expense to write something down, like waste management should have, but didn't. Also, they talk about investments, market value. That's changed. Mark to market, you hear sometimes in the news. That's something Warren Buffett doesn't like at all. That you talk about that in the shareholder letter here. Well, every year, the last 2 years anyway. That if the value of the investments go up, even though nothing was sold, you have a holding gain, but you could have a holding loss as well. But when things go up, and of course he's a long-term investor, he doesn't sell much. When things go up, they had to show that as income or gain. So that's something that's changed from when I went through school back in the 80s, have such thing as holding gains and losses. You could have a holding loss, but you would never have a holding gain. It goes against conservatism principle. And that's one of the things that really kind of goes against those principles, especially talking about conservatism, of actually writing something up that you've not sold. You've not realized that gain. You're recognizing a gain on something that you haven't realized. I mean, you haven't sold it, you've got a holding gain. It's like people look at their 401k every day, especially when the stocks are going up, right? Well, they look at that, that's a holding gain. You didn't sell it unless you transfer it out of that mutual fund into something safer, right? Like to a guaranteed fund. That's a realized gain. But here it's talking about a holding gain. And a holding gain is just something that's booked and didn't used to be the case. Rest of these, I'm not going to get into that much detail on. Page 44, the balance sheet. It's a good picture there of how they put that in here. You got assets over there on the left side. And the total there. And the total at the bottom has to equal the liabilities and stockholders' equity, right? Assets equals liabilities plus equity. So a lot of times you see a left to right display of the balance sheet. So the total assets is $550,000. So your liabilities and stockholders' equity has to be $550,000. And then they show a vertical presentation. There on the other page, page 45. All right, and then that gets to the actual test yourself. See, that's a short chapter. You got to do this. I mean, make sure you understand what's going on. The answers are in the back, but do a not only do what's in the book here, do one for yourself. Do a balance sheet of your financial situation or financial position. What's your car's values? Do you own them? How much do you owe on them? Put the full value that if you sold it there on as an asset, and then whatever you still owe on it, put under the liabilities, and then the equity is the difference. Same way with the house. You buy a $100,000 house, or if you have a $100,000 house that you possess, you live in, the $100,000 is an asset. How much do you owe on it? If you owe $80,000, then you got liabilities of 80, and your equity is 20,000. Right? Do that, and you'll be surprised what your net worth is. It's a great way to understand what's going on in your business, because it's not any different for a $10 billion company versus someone who just has a few $1,000s. If that, right? Maybe easier than you think. Hope you don't have negative equity. You might. I've worked for companies that had negative equity. That's pretty scary. All right, and then the key points to remember on page 49. Then on page 51 is the income statement and retained earnings. Kind of going backwards in some ways here, because I would talk about income statement first because it flows to the balance sheet. I don't know. I guess I'll have to write my own book if I want to do things my way. But really, the income statement flows into retained earnings, which is your balance sheet, right? Go back to that one-page PDF, and a lot of this seems redundant, but I think me talking about it in different ways, it may sink in more than just hitting it one time. You know, they talk about on page 53 and 54, revenue and expense recognition. So this goes right along with these first two cases. So I want you to learn from this book how you can take this information and formulate your answers and your understanding of accounting without having to make journal entries, right? And creating financial statements. But you need to know what's going on with these principles and just the basic mechanics of accounting. Revenues and expenses, there's also gains and losses associated with what's going to be on your income statement, right? If you have an asset that you sell higher than the original cost, if I've got a cost of $1 million for an asset and I've got accumulated depreciation of $600,000, then my book value is $400,000 on my balance sheet, right? So if I sell that for $500,000, then I've made $100,000, haven't I? From taking that off my books. Well, where does that go? That $100,000 goes to my gain, right? I debit what? I debit gain for $100,000. I debit accumulated depreciation, and I credit the original asset, right? And that $100,000 has to be the difference. All right, revenues and expenses. SG&A on page 56, selling general administrative. We'll get into more of that in managerial accounting, about how you can slice up these costs to make it more usable from an internal standpoint, but we're talking about financial accounting, these first 8 chapters, financial accounting, which is all about external creditors, the SEC, your shareholders, your bondholders, all those folks that want to see your financial reporting through these income statement and balance sheet, retained earnings, and cash flow statement. Gross profit, gross margin, again, that's looked at many times when you have a sales minus your cost of goods sold is your gross margin. Where your cost of goods sold is what you're actually either buying and reselling, like in a clothing store, like a Belk or Old Navy or whoever it might be. But if it's a manufacturer like an Eastman or an Exide or a Lear, that cost of goods sold is what you manufactured and sold. So the difference between your revenue and that cost of goods sold tells you what your gross margin is. And your gross margin minus your SG&A, all that overhead, which is usually your corporate office, which is expense, then tells you what your net income is. All right, so that's what, when they're talking about gross profit, what they're referring to. You're sort of comparing your revenue from your product with what it takes to either buy or make that product specifically. Income statement format. And they do a good example there showing you 2 different formats. Get my fingers out of the way. Revenues up there at the top. Sales minus gain, or excuse me, sales plus gains is total revenues. Then my expenses, it lists all of those and net income. But at the bottom, the multi-step process, that's what it's talking about, net sales minus cost of goods sold. It's either a merchandising or a manufacturer uses that format for external reporting. Again, this is external reporting. Two different ways you can show that. All right. A lot of times people like to see what's the gross profit. How well are you doing gross profit? And then they compare that with other companies in your peer industry. You look at semiconductors like Micron Technologies and AMD and Intel. They're looking at gross margin on what are their sales of all these chips and so forth, minus the cost of goods to manufacture those chips. What's your gross margin? Because they feel like they can control that SG&A, but they want to see what the margin is. You know, if you ever watch Shark Tank, or what's the one that's got, I can't remember the guy's name, the Prophet, I believe. They're all the time talking about margin. Well, they're talking about gross margin. They don't care about all that SG&A stuff. They know they don't even need that if they're going to assume that company into their company. They don't know what the margin is. What's it cost to make something, and what are they selling it for? Your margin. Then on page 59, it talks about what I've been talking about a lot, earnings per share. So important, earnings per share. What is your net income minus preferred dividends divided by your what? Your common shares outstanding. Actually, weighted average common shares outstanding, because that can vary month to month. What's your weighted average number of common shares outstanding for the year? That's the denominator divided into your numerator, which is your net income minus preferred dividends. I always pull out that preferred dividend because it has no impact on income. All right, that's an after-tax thing if you're going to pay preferred dividends. And it's always common shares outstanding, because that is ownership in the company. Ownership. Preferred stock is not ownership. It's stock, but it's not ownership. Preferred stock is really a lot like debt, even though it's not classified as debt. It is an equity account. Statement of retained earnings, that's where you just want to start with your balance sheet retained earnings from the previous period, and then what is it in the current period? Well, what's the difference in retained earnings? Well, retained earnings that you start with, let me just write that on here. You're probably tired of looking at me. Beginning retained earnings, you're going to add plus what? Net income minus dividends is going to be your ending retained earnings. See how easy that is? Let's say we started with $1 million in retained earnings. We had net income of $250,000 and dividends of $50,000. What's my ending retained earnings? If my math's any good, 1.2 million. So again, statement of retained earnings is just taking your balance sheet. That's your balance sheet from last period. Balance sheet now. This is if this is 1 year, what was my net income? Gets added to my retained earnings, right? Any dividends I pay out, because what does it take to pay dividends? Retained earnings and cash, right? It's not expense. So dividends comes out of my retained earnings. So my ending retained earnings is 1.2 million. That's all there is to retained earnings. It's always except for a prior period adjustment. If you have a material error, material meaning significant, materiality principle, if you have a material error, you've got to go back and adjust the prior period. You can't adjust it through you can't adjust it through revenue and expenses. It has to be through retained earnings, because remember, your income statement accounts, revenues and expenses are zeroed out every period. So the only thing you've got to track is retained earnings for those prior period earnings. So a prior period adjustment can be a positive or it can be a negative, depending on what happened. Maybe expenses were overstated in a prior period, right? If it's overstated, then you're going to have an increase in your retained earnings from the prior period. Maybe you over accrued revenue, made an error. In that case, you're going to have to adjust your retained earnings down. But that's the essential of what's going on here with the statement of retained earnings there. All right, and so again, we're at the end of chapter 4. And please work through these exercises and make sure you understand what's going on so you have a good grasp in your career, because this is about you taking ownership in your education here and understanding, because this is not just a piece of paper, what you are able to glean in this class, not just in the cases, and you can show me in the cases what you know, but make sure you understand a lot of the technical support. You don't have to be an accountant, but just understand what's going on there so you can think through. Because companies look for, they want people that can relate to other people and can motivate them, and they want someone who knows the numbers, right? Believe me, it's what they're looking for. People who know the numbers and people who can work with others and get things done, right? All right, so that's chapter 3 and chapter 4. And again, this is going to serve as both our third and fourth meeting, or third and fourth week. So you've got these 2 cases that you're working on. You may have already finished the revenue recognition, but after reading these 4 chapters, you should be in pretty good shape to be able to write those 2 papers. All right, we'll talk again soon. I hope you have a good week.